A key difference in our strategy is our unique implementation process via the use of cash-backed exchange-traded put options. It's important to note that the option strategy is used to reduce risk and create greater certainty, has no leverage, carries no counterparty risk as options are exchange-traded in the local currency, and is never used for speculative purposes. For example, our process has identified a stock we want to own and think it's worth $125, but it's currently trading at $100. Instead of buying it directly on the market, we commit to purchase it at $96 in typically 2 months' time via the sale of a cash-backed, exchange-traded put option. A put option is a contract to buy a share at a price lower than the current market price and at a later date. The sale of a put option generates an option premium where the seller is paid a fee. In this example, we sell the put at a strike price of $96, so less than the market price, and we get paid a contracted $3 per share of option premium for the commitment to buy. And remember, this is a stock we want to own. So in 2 months' time, one of two things can happen. Either the share price is at or below the $96 strike price, and therefore we take ownership of the shares. So in this example, our entry price is actually $93, the $96 minus the $3 option premium, for a share that was $100 and we believe is worth $125. Or, if the share price is above $96, we don't own the shares, but we keep the $3, which is treated as income for our investors. It's worth pointing out that in this scenario, we often will immediately rewrite the option, generating further income. We target a minimum 15% annualized return from this option process, and because the option premium increases during times of market volatility, we can often generate more income when markets are falling. We will never invest unless the potential upside is greater than the potential downside, so a favorable skew, and has a minimum upside of at least 20% to our fair value estimate. All of our options are exchange traded and fully cash backed in the local currency, eliminating leverage, FX, and counterparty risk at the time of trade. We do not borrow to make investments. Implementing by selling a put option creates a downside buffer to first loss, generates significant levels of consistent income, reduces portfolio volatility, and diversifies sources of return. It's worth noting that when we exit stocks, we often use call options, which again creates additional premium for our investors. This integrated process of research and implementation helps generate our 3 key outcomes: consistent income, less reliant on company dividends, capturing most of the upside of markets and less of the down, and reducing portfolio volatility, creating a smoother investment journey. At Talaria, we believe the most compelling way to compound investors' real wealth is by utilizing multiple return sources to deliver superior risk-adjusted investment outcomes. This is practically achieved through a combination of returns derived from capital gains, the stock selection process, as well as dividends and option premium. Thank you.